U.S. inflation cooled to 3.5% last month thanks to a drop in energy costs. Even so, many Americans, and Alison was just talking about it, are still feeling the squeeze when they go out. It's what PNC Bank calls funflation. For example, the price of tickets to a sporting event has gone up more than 10% on average since 2019. Over the same time, the cost of movies, theaters, and concerts have gone up by nearly a third. So you might think it'd be fine, I'll just stay home, right? I'll have fun at home. Well, that's gotten more expensive as well. Video games prices have soared 52%, and cable TV and streaming have risen 28%. And I know many people have noticed that increase. And then there are all those ancillary costs, the internet, electricity. I could go on.
Amid the new strikes, traffic has slowed through the Strait of Hormuz after oil prices made their biggest single-day jump since May, and gas prices followed. AAA says the average U.S. gas price surged 5 cents a gallon to $3.85 a gallon overnight. That's the biggest one-day gain in more than 2 months.
A 5-cent overnight jump is something to watch, but because crude oil remains in the $70 barrel range, that is a bit of comforting news because we haven't seen crude oil spike into the 80s or 90s or even above $100.
Earlier today, oil prices retreated, with some observers doubtful the conflict will make a full-scale re-escalation.
The Strategic Petroleum Reserve is being drained rapidly. Chris Martenson did a report recently talking about how essentially the buffer that we have runs out, I think he said October. And he's actually being quite generous. It may not last that long. And what's clear is that in the United States, gasoline will probably not be in short supply because gasoline tends to be a derivative of the kind of oil that we produce domestically. But diesel and jet fuel are the problems. As I mentioned earlier, and of course, the impacts of that are wide-ranging. There's really nothing that can be done domestically to solve that problem. And that's why I'm talking about the downstream effects of this. Yeah, we have oil, but it's not the right kind of oil, and we don't have the refining capacity that we need to get enough of these products to run the economy that we're used to.
Dr. Peter C. Earle is the head of research at the American Institute for Economic Research. He's an economist specializing in financial markets, monetary policy, and macroeconomic analysis. And he is the author of Gold in Uncertain Times. We are very happy to have him as our guest today. How are you gentlemen doing? Okay?
Fantastic.
Great. Thanks for having me.
So I want to know what somebody with very little money can do. You know, it seems that whenever we're talking about the economy, how to cope with it and so forth, and how to advance, the advice seems to be geared more towards people who already have a lot of money. What about somebody who has very little? I'm asking for a friend who looks a lot like me.
Well, I mean, each person has to make their own decisions. I mean, generally speaking, people have to allocate money between savings, between spending, and investment. And, there's no one right answer for every person. Certainly, we do know that when there are uncertain times or when the economy is in certain states, people allocate more towards saving and less towards spending, less towards investment. But, it's a combination of where we are in the economy and also what every individual's risk preferences and what their needs for liquidity are. So it's really, there's as many answers as there are people in the U.S. economy.
Well, Steve Martin has an old joke. I don't know how good the advice is, but his advice on how to become a millionaire is first, get $1 million. And frankly, I can't think of a better way to become a millionaire, actually.
Well, let me jump in here and speaking first for the common man, why should somebody actually trust somebody that is from Wall Street on these decisions? And the reason I say that is because now people say, well, you can go to ChatGPT and you can put something in there. Or, hey, if you're a little younger, you can go to Reddit and you can put something in there. And there's all kinds of advice and things like that. And then on the news, for example, today I was seeing that country of Poland has suddenly bought up, 82 tons of gold just in 2026 alone, which is, that's sizable. It's not on the level of China. So how does a person who's trying to figure out to stay afloat, have a future, how did they actually wade through these things? Why trust you?
Yeah, I mean, it's always complicated. So, I mean, I would say that people should gather information until they're comfortable with what they've come up with. And some people, they have they'll hear one source, whether it's a book or a magazine or a personality on TV, and they'll trust that one. And others will say, I've listened to 30 people and read 10 books, and I still don't believe it. And that, again, just like my answer about what should someone do with little money, that's the same thing. I would say that keep asking questions and keep doing research until you can sleep at night or until you're satisfied with the information you've received.
So one thing on this and I would like to get your thoughts on this, because we have a new Fed chairman right now, and I was let's see his name. I'm just thinking here a sec.
Kevin Warsh.
Kevin Warsh, right? And he just testified before the Congress. And he discussed inflation. The way that I understand it is we were supposed to get good news. The interest rates dropped to 3.5%. That was due to a temporary oil price drop, and now the Iran war has sort of reignited. So there is this kind of instability on the one hand. And then yesterday, correct me if I'm wrong, gold, there was like a $100 an ounce sell-off, possibly due to the fact that inflation reporting wasn't as good as hoped. So can you give us some big picture ways of thinking about these things?
Sure. So Warsh is the new chairman of the Fed, taking over for Jerome Powell. And he is already changing things up a bit. He's kind of I don't know if it's early enough to call him a reformer, but he's changing some of the way the Fed does things. One thing in particular, he's going to remove forward guidance, which means he's not going to give as much information about what the Fed plans on doing as former Fed governors did. There's some reasons for that, one of which is because he wants to maintain the Fed's latitude to respond to information as it comes out. The idea being that if the Fed says, we're thinking of easing, and then other news comes out and they have to reverse direction, people might be misled. So he wants to increase the degrees of freedom that the Fed has. We did have a good inflation number yesterday. And again, good, we're well above the Fed's target right now. By good, I mean better than expected. And that has mostly to do with the fact that in May and June, we saw oil and gas prices falling. So, with the events in the last 2 days or so, with the collapse of the MOU between the U.S. and Iran, we might see oil prices and therefore gasoline prices surge again. So that's what's going on there. It's very back and forth in terms of what's happening between the U.S. and Iran, and therefore oil prices. As for gold, the expectation yesterday was that inflation would be hotter, and that would mean that the Fed would be more likely to raise rates in the future, and that would push the gold price up because of course higher interest rates mean more uncertainty, and of course gold would become more valuable. I think gold sold off because we had a better rate inflation than it was expected, and it lowered the possibility that the Fed would raise rates. But again, gold moving $100 or $50 back or forth, really sort of small moves compared to what we've seen in the last, year, and really since the pandemic. So it's a small move.
So explain a little bit more. Why is inflation good for gold? Because it still seems like the bigger picture, we're still in an inflationary kind of a world.
Yep, we are. So higher inflation means that essentially that your money is losing value faster, and gold is, among many other things, a store of value. So gold becomes more valuable. More people put their money in gold when we have high inflation, and that's the essential relation there. If we saw gold sell off yesterday, that had to be because it was expected. Now this has to do with expectations and realization, right? So if it was expected that inflation would be higher, that would have sent gold higher. But because it wasn't, gold sold off a little bit. And again, for a metal that's been between $3,800 and $5,000 in the last, year and a half, 2 years, $100 is really not that much.
Oh, yeah.
You mentioned oil a moment ago. Yep. We've been told that the strategic petroleum reserves are just about out. What can you tell us about that?
Well, they are very low, and that's an issue because what that means is that in case, the situation in the Middle East takes a turn for the worst, or if, maybe we get more back and forth with Iran, maybe a higher escalation, what that means is that we have less sort of cushion to draw from, and that's a problem. Now, the thing is that the U.S. has been selling a lot of oil lately. We've been selling more oil than we have in a long time. So conceivably, we could cut back on those oil sales and use some to refill the Strategic Petroleum Reserve. But, right now it is true that we are at the lowest level since, I believe, 1983.
Right. That's what I had heard also. And then I was talking to somebody yesterday on this topic, and they were saying now, in terms of looking at that Middle East situation and our oil, right? We produce the sour, right. We're sour crude, whereas the Middle East is largely sweet crude.
Right. So, I mean, that's an interesting point, because usually in futures markets you see, or you hear, two kinds of oil reference. You'll hear about Brent and you'll hear about WTI, which is West Texas Intermediate. Brent is kind of the European Middle Eastern crude, and West Texas Intermediate is ours. But there's actually a lot more differences between those two. Has to do with specific gravities and things like that. So, we can refill our reserves with some of that. But the fact is that, for example, Venezuela, right, they produce what's called a very heavy crude. So it's much more sophisticated than there being simply two types of oil in the world. And so we do occasionally, even if we were to produce, nominally all the oil that we need, we are still going to need to buy certain oil from overseas and from other sources, because there are different kinds of oil.
Right, and then it's out of that sour that you get diesel and jet fuel, kerosene.
Jet fuel, which is JP6, and kerosene, and some of those other more, if you will, exotic types of distillates.
And that's what you need for development. Oh, sorry about that, Jeff. That's what you need for industrial development, for infrastructure, for the real. Yeah. So then, I guess to me, then are we in an unstable time, would you say, from that standpoint? And therefore, the gold question is that is something we need to take seriously. It's not just, hey, rich people buy gold.
No. I mean, each person will have to assess on their own what their risk tolerance is. But in terms of diversification, many people will find that having something in their portfolio which is less diversified with stocks and bonds and all those sorts of things can be a good thing. As for whether we're in an unstable time, I mean, I'll say non-categorically, uncategorically, yes, we are. Right now we have what's going on in the Middle East. We have inflation, which is high, not as high as it was, but it's still kind of sticky. It's still kind of refusing to come back down. The other thing about oil prices being high is that what it means is that so I think of it like a signal to noise ratio. Oil being high makes it more difficult for the Fed to see what's happening in other prices, because oil is not like, copper or other widely used commodities, because oil touches basically everything. It touches production, manufacturing, transportation, the gasoline that consumers use to get to buy things, so consumption. So oil being involved in everything makes, again, a high noise to signal ratio for the Fed to see what's happening. So when oil goes down, we may find out that other prices have been rising and they were harder to see. So again, a lot of instability in energy prices, in the economy, in terms of, we have still reasonable but somewhat softening employment. Again, interest rates are rising right now without the Fed tightening, so that's a unique situation. The 30-year Treasury is near 5% for the first time in a very long time. So yeah, a lot of movement in a lot of fronts, which increase uncertainty. And really, uncertainty is kind of the biggest danger. Is when people are uncertain, when businesses face uncertainty, what they tend to do is not to act, negatively or positively, but simply not to act. And that causes a lot of sluggishness in the economy.
What about other petroleum products? Are we going to see the prices rise there as well?
Yeah, I mean, they're all going to move in tandem pretty much. When oil moves up, all of them will move up. But it's going to be a question of, the refining capacity and the demand in that particular good and all that thing is going to affect the lag, which means, of course, if oil moves up, $1, how much and how long does it take for kerosene or for diesel or for other products to rise? It really varies depending upon what's happening in that particular sector at that time.
Yeah, I can't remember all the products, but I remember reading an article and I was surprised to see how how many products have petroleum, and obviously
Sure.
petroleum jelly, Vaseline, but plenty of others have it too. Yeah.
Yeah, I mean, I was going to say things like petroleum jelly and things like, lubricants that are used in manufacturing, all of those things are going to be tied to some extent to another. Some are more highly refined than others. Some are, require more industrial processes. But, that's actually one of the ways that Rockefeller got so rich was there was so much waste in oil manufacturing. He found out that there were lots of industrial uses for the runoff. And of course, when you discover that, you've really discovered a whole new industry. So, I mean, that's part of what made, Rockefeller's Standard Oil so successful early on was, that amount of waste that was being produced could actually be used for other industrial products that had a lot of demand.
So I want to delve into your historical knowledge a little bit. I'm a student of Alexander Hamilton. I like what Nicholas Biddle, who was tied to the First National Bank, Second National Bank, which Hamilton really used to develop the internal industries of the United States. Now, I bring that up kind of because I got problems, and I know you don't talk about specific people, but we're talking policy. Scott Bessent, in my view, actually doesn't know economics as well as I would hope he would, even though he's invoked Hamilton and the American system. Now, Peter Schiff, he asked, and I'm going to ask you because I would like to know your thinking. He says, doesn't it bother you that the current Secretary of the Treasury doesn't know that the U.S. halted redemption rights on all gold and silver certificates a decade ago or decades ago? He said, if Scott Bessent is this ignorant of a basic historical fact regarding U.S. currency, what else doesn't he know? I don't know what else he doesn't know, but I'm wondering in terms of, okay, so one thing is my own investments, but then the question is how the nation functions to address some of these instabilities. What about this idea of the national credit investment for infrastructure and development as a way of both expanding the labor, that population, the number of people that are taxpayers, and addressing some of these instabilities that we've been talking about, just to make the country more stable. What do you think about something like that from history?
So, I mean, a large-scale infrastructure program, if that's what you're speaking about, that would have to be viewed in the same way I would view something like the New Deal or any of these other plans that have been put forth to, say, buy stakes in companies and all that. The first is that it's very difficult for governments to do that because they are, central planners, and they don't have a lot of the information that's necessary to make those decisions in a sound and timely way. Information tends to be dispersed, it tends to be local, tends to be based not upon book knowledge, but also on circumstantial and tacit knowledge, that sort of gut instinct that many people have, whether they're entrepreneurs or whatever else. So, big programs like that, first of all, the government is really not equipped to make those sort of decisions competently, certainly not more than private industry. But also, those sorts of things, however well-intended they are, they often become a nest for special interests, right? You'll find certain states will give aid to certain either unions or corporations or interest groups that are not necessarily where that money should best be spent. And also we have to consider the trade-offs. For every dollar that is, say, taken from taxpayers to put into, say, infrastructure fund, what are we not getting? Because there's only so much economic output and there's only so many dollars. And there's only so much income, that can be taxed away from taxpayers. So what are we not getting? Are we not getting, say, a new product? Are we not getting, say, is money not going into some, entrepreneur's pocket who could create the next whatever we need, product or service instead of that? So, I mean, I would view that with some degree of skepticism because I think that a lot of these programs, however well-intended they are, however well-planned, they often tend to go off the beaten path and become far more costly and accomplish less than we would hope.
Well, I think to a degree you're right, but I want to maybe play devil's advocate on this and
Sure.
make some contrasts on this. Take, for example, nuclear power. I'm a big proponent of nuclear power. I really don't know why we haven't just gone haywire with this. And that
Sure.
doesn't mean we wouldn't use oil. It's just another form of really good, consistent, cheap energy. China is in the process of building right now in 2026 39 new nuclear power plants, and then second place is India with, I don't know, 6, and Russia's 5. We are 0. Europe is 0. Of course, that is a lot of state investment, but there is private investment in that. Now, that's one thing. And we have a big regulatory mess, as far as I can see, with just, what snail darter are we not going to dig up to build this, right? So there's that. But a lot of money right now, huge amounts, is going into AI. And in terms of what you're saying about what are we not going to get if we're putting money into this. Now, here's the interesting thing to me. Like Y2K, everybody had to go buy new computers and equipment and all this. It's tons of money being spent. Everybody's like outspending. And that's today too. We're outspending. This guy is outspending that guy. But in fact, it's going to be a bubble again, as far as I can see, until it comes to a normal level where it becomes useful. So these are two examples to me. Ironically, for AI, you need nuclear power. But it seems that it's not moving at the rate that we see in, say, a place like China.
Yep. So, two things I would say there is, first of all, I am all for the development of nuclear power. The issue there is not the spending, but the regulation, right?
Yeah.
Regulatory burdens are so huge, and there are so many, and those two, by the way, are often a product of special interest. Who lobbies most for, and who lobbies most successfully for a certain cause. So I absolutely would be in favor of seeing regulation lifted and see where we go. I have no aversion to things like alternative energy. But what I don't want to see is to stop producing oil or stop producing what works right now while those other things are being developed. We should be allowing these to compete. And if one day it so happens that there's another form of energy that's better than oil and it's more cost effective, that's what will happen. That's not the case right now, though. So there's that. Yeah. The other thing is that, we are definitely seeing a lot of private investment go into AI and that sort of thing. I am not a fan of the government either subsidizing those firms or, this new, I just heard the other day, this plan about trying to take or taking half of those companies away from their shareholders or whatever. Really, really, really bad ideas for any number of reasons.
I agree with you on that too.
Yep. So I will say one thing though. You mentioned that you think AI could be a bubble. I think that I sort of agree, but with a qualification. I do think that AI right now is being massively overbuilt. But the difference I see between that and what I saw in the late 1990s, early in my career started 30 years ago in the mid 1990s. What I remember is in the late 1990s with the dot-com companies, those companies were nothing. Most of the 95% were air. They were an idea. They were a website. They were measuring their, they had no revenue. They had barely any profits. And so when they collapsed, they just disappeared. In the case of AI, most of these firms are real companies like NVIDIA, like Micron. They actually have real businesses and they're doing this on the side. However, I do think that most of them are, my personal view as an economist is that many of them are being overbuilt. There will be demand for AI, but will it be at the levels that will justify the current spending and these data centers all over and that sort of thing? Somehow the experience we had with telecom rings a bell, that we built a lot, way too much that would ever be used, or at least, that capacity wouldn't be absorbed for, 20 years or so. So I'm not saying we're going to have a market crash. I'm not saying we're going to see widespread failures, but I do think that there will be eventually some sort of retracement in all of this investment, and that not all of it is going to be profitable.
And so I'm wondering, therefore, if like on the nuclear power side, to get it moving, and I don't disagree with you at all about oil. I think these things are parallel, but nuclear power has been proven with the nuclear navy going back. Sure. That would be an example to me where you would want government credit to, and also regulatory. I think in China, they did basically change all the regulations to make it happen faster. And,
sure.
And I mean, you're right about that 100%. Because it's like, why do we have to, it's like watching paint dry to see if the Congress will ever let anything happen.
Sure.
But that's an area where I think the government could play some kind of role because it will help these private businesses to get these other things going. But what you said about the AI is interesting because it also isn't like supply chain stuff. And maybe Apple had to raise their prices for the first time on some of their hardware.
Yeah.
But I thought they had $1 trillion in the bank.
Well, I think they were they have a market capitalization of $1 trillion, but they only have a few hundred billion in the bank. Yeah, I mean, the reason why they raise their prices is because they are now competing in the market for chips, because those chips are being sucked up at higher and higher prices by NVIDIA and all these other companies. So, I mean, that right there is a sign that there's, growing competition for these chips. And I will say this, I don't know exactly how the AI companies are using them. I know a little bit about it, but I mean, Apple is a much more mature business. They have a much more mature sort of product based on all that. I'm willing to bet that there's more efficient use of those chips by Apple than by these AI companies. So the idea that prices are having to be raised just makes me suspect that they're maybe not being used either efficiently, or they're being bought and used in a way expecting demand that might not be there now and might not materialize for some years. I mean, AI will definitely change our lives, but will it change them as quickly and to the extent that these prices and these events, the pace of this building seems to suggest it will? I'm not sure of that. I have my doubts.
Well, it's already changing my life. I'll tell you that. It's a big help in my daily work.
Sure.
Let me ask you another question. What do you think is the biggest misconception about where the U.S. economy stands today?
I would say that the biggest misconception is that you can sum up the U.S. economy in a single number, right? So, strong employment doesn't necessarily mean households feel financially secure. A rising stock market doesn't mean that every business is thriving. I mean, it's important to remember that the U.S. economy is a collection of millions of households and firms, and each one experiences different conditions. So, people will say, oh, the economy is doing good, it's doing bad, it's doing whatever. In reality, economies move through cycles. And today's environment, I say, it reflects a mixture of both resilience and uncertainty. The picture is a lot more nuanced than the headlines suggest. And those headlines are easily skewed either for or against, certain political views. It's important to take them one step at a time and try to put them together, in sort of a more nuanced framework.
What do you say to people who are looking for ways to protect their retirement savings? Why might they choose gold or silver, and what role can a gold IRA play in an overall retirement strategy?
A lot of investors view physical gold and silver as diversifiers, not replacements for traditional investments like stocks or bonds or any of that, or ETFs or whatever, or mutual funds. Unlike stocks and bonds, metals like gold and silver don't represent a claim on future corporate earnings or interest payments. There's no counterparty there. So their value tends to be influenced by such things as inflation expectations and real interest rates. And so, because they behave differently than other financial assets, some investors choose to hold a modest allocation as part of a much broader retirement portfolio. Now, as for a gold IRA, those simply provide a tax advantage way for eligible investors to own those IRS approved precious metals within a retirement account. And like any investment, whether we're talking about municipal bonds or equities or foreign stocks, whatever, there are trade-offs, right? Precious metals don't generate any income. They can experience price swings, and they could certainly be viewed, but they could certainly be viewed as a component of a diversified strategy. And they're not, rather than say a complete retirement solution, right? How much and to what extent people should own, that's all about an individual financial objective, their risk tolerance and their overall investment plan, how long they have to retire and all that sort of thing. But the fact that they are not owned by anyone else on the other side, they're not counterparty instruments, and the fact that they're not really correlated with financial instruments is a very important principle, I think.
Well, our sponsor is a precious metals seller, Gold Coast specifically. Yep. And Ryan did some detective work right when we were just getting started with them. And he called up and just acted like he was any customer calling up instead of, hey, I'm a guy affiliated with this podcast that might be working with you. And what did you learn when you called, Ryan?
Well, what I thought was really good is, and it's funny because I can talk about national economics much better than I can about my own personal. I always need help, right? So I like to ask a lot of just basic questions. And I found that they were totally, they were right there with me, right? Kind of walking me through the steps of each part of the process, why I would do this, why I would do that. And so a lot of that nervous tension that you get when, oh my gosh, this seems like such a big change. Totally eliminated that, and it was really quite pleasant.
Yeah. Ryan already knows a lot about this stuff, and I don't. That's why we had him do the detective work. I'm like, a lot of this stuff is just like Greek to me. And one of the things that I thought was kind of weird is a lot of these sellers, they don't actually provide you with the physical gold or silver. They give you some certificate or something. That seems so weird to me. I don't know really how often there's actually any problem obtaining it when you need to obtain it. What's common in the industry in that regard?
There is an ETF, which is GLD, and that's basically paper gold. It's essentially it's called a depository receipt, which means you are buying a piece of paper that has a certain amount of gold backing it. But I mean, for various purposes, various types of gold are going to be appropriate. I talk about a lot about that in my book. There's physical gold. There's physical gold that you can own held by someone else. There's, of course, the ETFs, which are like GLD. Some people want to own one physically, the other in paper or whatever. It really depends on what your purposes are. That's really how it shakes out. It's really different people have different goals, and even once one has decided on owning gold or silver or whatever else, then the form is another discussion.
Well, actually, that's a good question.
Yeah.
Let me jump into that. I have actually liked to own physical gold and not gold paper, as you're saying. I have ETFs. And I love that some of them pay dividends and things like that. So that's great. And but this instability thing that you were talking about earlier makes me feel like I need to have some physical gold. So I did buy a number of gold coins over the last number of years. And then I saw this thing, which I never thought about it before, was investment jewelry. So it's like, instead of 10% gold, it's 24%. 24 karat gold, rather.
Yeah. And I mean, you raise a good point there, and that is that if you're buying GLD, right, which is essentially paper gold ETF, you do have a counterparty. When you're holding a piece of gold or silver in your hand, that's your gold, right? Nobody can come between you and it, right? But when you have a piece of paper that says you own a share of this ETF or whatever, there's a brokerage firm in which you're holding it. And then there's also the firm which is issuing the depository receipts. So there are a few links there. And if you want to have no counterparties and be, have some form of wealth which is directly accountable to you, then physical gold or physical silver is your best choice. It's your most likely choice.
And with IRAs, there is no way to do that. Is that right? I
would speak to Goldco about that.
Oh yeah. Okay. Great.
I'm not 100% sure of the different rules because the rules change and the tax rules change. So I'm not 100% sure.
So I got one more thing I wanted to bring up because I saw the cover of your book. Great title, Gold in Uncertain Times. And I think you've got FDR there probably signing some New Deal, something or other into play. What in history, was it a bad thing that we took the dollar off of the gold reserve standard? A lot of people are afraid of, what is it? The Creature from Jekyll Island. I've heard that book a few times. Can you make some sense of that, demystify or clarify some of that?
So when the last link between the dollar and gold was severed in August of 1971, that was a tenuous link, but there still was a link there. I mean, if you look at the long-term trend of many financial indicators, many, markets, that sort of thing, what you find out is that ever since that date, and it took a few years, but ever since then, you have persistent inflation. You have, long-term inflation of asset prices, which is good for some and not good for others. You have the fact that the dollar has lost since August of 1971 somewhere between 95 and 98% of its purchasing power. That was a very subtle, but I think an extraordinarily key moment in economic history when the dollar's last link with gold was severed. Will we ever go back? My personal view is that yes, we will one day, but it'll have to be because we have to. It'll be because either nobody trusts the dollar, or we have more competitors, or because people don't want to buy our debt. There will be some form of some I think emergent situation where we will once again have to tie the dollar to a physical amount or fineness of gold. I think that's inevitable. Whether it takes a year or 50 or 100 years, we'll have to see.
Yeah, and it seems like that might be better than the so-called petrodollar because of what
Oh,
we're
sure.
seeing now.
Yeah. I mean, that arrangement helped to maintain some demand for the dollar. And the fact that the dollar is still, even now, 50 something years later, used very widely around the world has been very lucky for us, because any smaller currency, which any smaller currency which has less demand, it would have been, the situation would have been far worse than it was with the dollar. We are lucky to have a massive economy. We're lucky to have, entrepreneurship and property rights in two massive oceans on either side of us. We're really very blessed in many ways. But I mean, we're starting to see the limitations of those benefits, and the more quickly we can tie the U.S. dollar to a fungible, or to a really sort of stable value, whether it's a commodity or something like that, I think gold or silver would be perfectly fine. The sooner we can do that, the sooner we can ensure our future and start planning for much longer term growth.
Well, before we let you go, Dr. Earle, can you tell us what economic indicators you're watching and what you think we should be watching?
Sure. I mean, right now I'm watching the price of oil and gasoline in the U.S. AAA puts out an average gasoline price every day, so I watch those. Another I'm watching is non-farm payrolls, how quickly the most broad measure of job creation is growing right now. Reluctantly, I do watch the stock market just to see what sentiment is, although it's a really unreliable indicator because the stock market time horizons range from like 30 seconds to 10 years. So that's not really reliable. So I would say, oil and gas, I would say non-farm payrolls, which is the once a month employment report put out by the Bureau of Labor Statistics. And also, I think that we should also be watching the yield on the 10 and 30-year Treasury bond, because it's been a long time since we'd had a 5% yield on those. In fact, I believe it's since 2007 that we had a 5% yield on the long part of the yield curve. And when that gets up to 5%, it means a few things. It means that we're getting higher interest rates, which are making people's loans and that sort of thing more expensive. And it also means that bonds are starting to compete more on a risk-adjusted basis with the stock market. That's going to affect a lot of investment decisions. So those three are the three primary ones I'd be watching right now.
Fantastic. Well, thank you very much for those insights. We really appreciate your time and you sharing all that knowledge with us. If people want to keep up with you, they can follow you on X. There is your profile there. Those underscores can be a little tricky to remember, but
sure.
Peter_C_Earle with an E at the end of Earle.
Yep.
And the American Institute for Economic Research, the acronym is AIER.org. And I know your book is available at Amazon, I assume everywhere else too, Gold in Uncertain Times by Dr. Peter C. Earle. Thanks again.
Thank you very much.
Thanks so much for having me. I appreciate it.